Mr. Paul.
Thank you, Mr. Chairman. Good morning, Chairman Greenspan. I find it interesting that you, as your as the previous chairman of the Federal Reserve, I remember 4 total, they've always advocated that we in the Congress spend less, and it really hasn't. The advice hasn't been taken. Currently, our national debt is going up over $700 billion, and we're pursuing, once again, a policy of guns and butter, and nobody seems to have much concern. But I think the Fed participates in this as long as you control a monopoly control over money and credit, and you can accommodate the Congress. I mean, if we spend and nobody's going to buy those Treasury bills, we know if you want interest rates at 1%, you're going to buy them. So in a way, you're complicit in what we do here in the Congress, but I don't see that coming to an end with the monetary system that we have. I do have a question dealing with your statement in the first paragraph about rising wealth contributing to the recovery. You know, this last recession has been written about quite extensively as being unique, that it came about not because you raised interest rates as the traditional, as it is traditionally for the Fed to raise rates. We go into a recession, then there's liquidation, and debt is wiped off the books, and then there's a restarting. This time, it just stopped because people ran out of steam. There wasn't enough consumer purchasing power, and we had a recession. But you very, very quickly and efficiently came in and lowered the interest rates very aggressively, and prevented, the conventional liquidation and the corrections that have come in the previous recessions. And Congress didn't hesitate for a minute to follow in its Keynesian path and, rapidly and excessively raise spending. But in addition to this, we have this very unusual and unique form of financing our houses, which has caused tremendous inflation in our housing prices through the financing of Fannie Mae and Freddie Mac, which in some ways the Fed participates. In many ways, the foreign central banks participate extensively in this. Anyway, we have a housing bubble. Housing prices go up, and that, I assume, participates in this wealth because the consumer has gone out and borrowed sometimes more than their equity. Of course, equity prices are soaring. That, to me, is like saying that we had great wealth when the NASDAQ was 5,000. And all of a sudden, that great wealth dissipated rather quickly. So I do not see how we can say that we have true wealth without savings that's created artificially by the excitement of easy money and easy credit and artificially rising prices, and then people go out and get into further debt. To me, it seems like the bubble leaked and you patched it up quickly, but we're back on the same track again of very excessive spending, excessive borrowing, and we never had the liquidation. What really are you thinking about when you're talking about the rising wealth that has helped in this recovery?
The term wealth in this context is a technical statistical term which is related solely to the question of the market value of net assets of households. Now, one can argue whether or not the market values that are placed on claims on physical assets are high or low. Remember that all judgments of wealth essentially are discounted values of forward expected returns, and that's people's sense of risk aversion is a critical fact in determining where stock prices are and hence where that wealth is. But having said that, whatever it is does impact, by all of the statistical analysis we are able to adduce, on consumer expenditures. And the reason for that is that people, when they become wealthier in paper terms, as you would put it, do have collateral to borrow and to spend, and they do. And that is indeed been an important factor in consumer expenditures over the last decade.
My question is it real collateral? That's the question.
Well, the point at issue is gets to the more fundamental question. If you're sitting out there with a big steel plant and you say that is wealth, the question is, it's people's judgment as to what are the amounts of steel and the profitability that will be engendered to enable what's the value, the ongoing value of that steel plant. And people's views can change quite dramatically, even if the physical plant doesn't change one iota, even if indeed the amount of steel they're producing and selling doesn't change.
But
So
I'm
what I'm trying to
afraid-
get at here is that you're raising the much broader question with respect to how are assets valued in the marketplace, and do we have rational or non-rational procedures by which those evaluations are made?
I'm afraid we're confusing debt with assets. That's my
Oh,
contention.
no, debt and assets are two wholly different things. And Federal Reserve, I will say, does not make that mistake.
Senator Sarbanes.